Hello and welcome to the Can I Retire Now podcast with your hosts, Nick Russell and Becky Wagoner. I'm your podcast producer, RJ Malik. Nick and Becky, I see you're both ready to go, so take it away.
All right. Welcome to another episode of Can I Retire Now? Here we are.
What are we going to talk about today, Nick?
One of your favorite things of all time.
Ice cream?
Taxes. Basically the same thing as ice cream, right?
Sure.
It comes in all different flavors, and this I can't relate it to ice cream.
No, don't try to do that. All right. What about taxes?
Okay. This is important, though.
Mm-hmm.
I mean, though, I guess whenever we talk about taxes is important. These we're calling the big four hidden taxes.
So there's obvious taxes and hidden taxes?
Obvious taxes, these are the hidden ones.
Excellent.
So when you think of taxes, you think of your income tax return.
And that is it.
Yeah.
I mean, I'm property taxes, sales tax, but more taxes I have to pay?
More taxes, and then like mystery sneaky taxes.
Sneaky taxes, hidden taxes?
Yeah.
This is like the haunted house of taxes.
Yeah, it's not great, to be honest. So let's
dive on in.
Yeah. So let's say you plan for your retirement, you've dotted all your I's, crossed all your T's.
Mm-hmm.
But a lot of people don't realize that taxes will now, of course, chip away at some of your money in your pocket. So whenever I think of producing retirement income for a client,
Mm-hmm.
I always think about writing them a check like every month. So after taxes, after fees, after investment
like a
costs.
paycheck with deductions.
Correct. Like here's the money you get to spend. But a lot of people don't think about it that way. They think about the withdrawal and not what's actually netting in their pocket.
It's exactly how I think of it.
Yeah. So let's talk about the big four. So these four are going to be how taxation works with Social Security, required minimum distributions, or what we call RMDs, which we've talked about a little bit, but
have we? Well, but okay, keep going. Yeah,
they don't come into play until later, so you probably just
Yeah, I blocked them out.
Gave me that was it Charlie Brown teacher noise? A little
probably.
Womp, womp, womp. Yeah.
Mm-hmm.
There is a ripple effect that happens with capital gains whenever you have gains in your portfolio. And then something called IRMA, IRMAA, and she is not your friend.
Yeah. For some reason, I'm recalling a Hurricane Irma.
Yeah, this is basically the tax version of that. So
there are never any good tax things, in my opinion. I mean, but anyway, that's just my opinion.
What do you mean, like tax candy?
No, there's never any tax candy, never any ultra plush tax snuggies, nothing.
No.
It's all just...
No, it's like concrete cinder blocks. And
shoes.
Yeah, it's like shoes that have like a little tack on the inside of the sole. Yeah. It's like always that. So...
All right. So let's get into this.
Let's dive in. Which one you want to cover first?
Let's talk about Social Security taxes.
Okay.
Because I feel like we've discussed that a little bit, how when you get your distributions or withdrawal, I don't know what they're called, from distributions from Social Security, they tax it. They know how much tax you should pay, but they don't always let you pay that because they're sneaky like that. Yeah. So what else is sneaky about Social Security taxes?
Okay. So first, a lot of people still aren't aware that you do pay income taxes on your Social Security unless you have very, very low income. So, and I was smart enough to write down the numbers today.
Got numbers.
So that income, by the way, combined income for married couples, married couple combined income. So these numbers are actually a little lower if you're single. If you make $32,000 or more in income
total
in retirement, total, your Social Security will be taxed in some respect.
Okay, that's a low threshold.
It's a very low threshold. So what qualifies as income when it comes to your Social Security? So it is your legitimate taxable income, working income, income out of your IRAs, but it also includes any non-taxable interest. So notice I said non-taxable interest.
What is that?
Municipal bonds and
the good old municipal bonds.
Yeah, that paid interest that isn't taxed.
Okay.
But the number is still added into your income to figure out how much Social Security will be taxed. And then half of your Social Security benefit amount.
Sounds like simple.
Yeah, formula.
It's not. That sounds like algebra.
No, and so let's give a real life example. Okay.
Yeah, that's probably more
simplify
helpful.
it. So let's say you have 50,000, you're a couple, you're retired, you have $50,000 of income.
A year.
From pensions, investments, and then you get another, I don't know, $30,000 on top from Social Security.
Okay, so you have an income total of $80,000 a year.
Correct.
So what am I taxed on out of that?
So they're going to look at the $50,000 you receive from investments and pensions,
Mm-hmm.
and then half of your Social Security. So half of 30 is 15,000.
Okay.
So 50 plus 15,000 is 65,000. That is what they're going to call your combined Social Security income, like taxable income.
Okay.
65,000. So I mentioned if you're under 32,000, which we're not, the next threshold is 44,000. So we're over that threshold.
Okay.
For income.
Oh.
The 65,000 is more than 44. Which means 85% of your Social Security benefits will be taxed as income.
Okay.
So I'm looking at your face.
I'm trying really hard, and I understand it in terms of like what you're saying, but it sounds like you need to know what you're doing.
Yeah. So it's not as simple as I make $100, I'm going to pay 10% taxes, I get $90.
Yeah.
It's I made $100, part of which is taxable, part of which isn't. Half of my Social Security counts towards that, but 100% of my Social Security is factored into that.
So the source of the money determines your tax level.
But let's be honest, for most people that are listening to this, you're probably living on more than 44,000 in income as a couple, which means 85% of your Social Security amount is taxable. So that means
85% of your Social Security amount
is taxable. The other money
100%
is 100% taxable. Yeah.
Excellent.
Yeah.
So clean cut here.
Yeah. So in this example where you had 80,000 of total income, 65,000 was being calculated for this number, you'd fall on the 85%. That means of the $30,000 of Social Security income, 25,000 and change is taxed as income.
Okay.
Which, if you don't withhold taxes from your Social Security, will just show up at the end of the year untaxed, and you will owe money.
Yikes.
Yeah.
So that is sneaky.
It's very sneaky, and it only way you could avoid this is to plan out how you take your income.
Okay.
So either having Roth IRAs, which are not taxable, or being very cognizant of when you reallocate investments that would create capital gains tax. So let's say you have a high income earning year. Let's say you retired this year, middle of the year. So you have some income from working. You have maybe the other spouse is already retired. So they're already getting Social Security. Maybe they have a pension. Plus you get PTO and all your sick time paid out. So all of a sudden you have a pretty chunky income year. You go to draw your Social Security again. I mean, 100% of your income plus 50% of that Social Security number is getting taxed. It can wind up being a really big thing. It might make sense to wait till next year to do some of those big reallocations that would create some taxable events when you're in a lower tax bracket. Yeah. I know you love tax planning. I can see it on your face.
Yeah.
You are just so into this.
Tickle. This is thrilling. Okay.
So we're talking about people in retirement. So by the way, for those that are our age, even in the 50s, even in your 60s, you can start to put things in place now to create lower taxable income scenarios. So whether that's Roth IRA conversions or how you're managing your other investments, so that when you get to retirement and you go to draw income, you actually have some options. So it's not all rain clouds and and thunderstorms and all that.
It still sounds like I would need to hire a professional or marry one.
Yeah, well, sorry, ladies, I'm not available. All right, so that I know that's a little ugly one, and that one, but I think that one creates a good base for all the other stuff we're going to talk about.
Oh, that's the base?
That's the base.
We're going up from here?
Well, it's important to know that those things are getting factored and how they play in.
Okay.
So the next layer to me logically is RMDs, or required minimum distributions.
RMDs.
And this one I know we've talked about, you really don't like.
What is it?
This is the one where the government forces us to take money out of our accounts. Just so
they're my accounts. Like, why do you make me? Okay. So when do they make me take stuff?
So anybody who's listening to this now and not currently taking their RMDs, because the age brackets changed. Back in COVID, they waited a few years and they moved the age number a couple times.
Make it easy. Just move all the rules all the time.
All the rules.
Okay.
Yeah. Keep somebody employed, probably. So anybody who's not taking their RMD now will have to start taking their RMD at age 73.
73, they say you've saved for retirement, use it.
Or 75, by the way. You didn't let me finish my thought there. So for us, it'll actually be 75. There's an age band. But anybody now, 73 is the number. We can use 73.
Okay. They say you have retirement accounts, use them.
Yes.
All right. Yeah. Did they tell you how much you have to use?
They tell you what percentage you are required to withdraw.
Okay.
There is a formula, a table, uniform lifetime income table. Very exciting stuff.
Labeled.
But let me just put it out there.
Yeah.
The IRS isn't forcing that withdrawal. A lot of financial firms aren't forcing that withdrawal.
Oh.
You, as the investor, need to know that you're supposed to take money out every year.
The honor system.
Well, it's the honor or penalize you heavily system. So
we can't enforce that. Okay.
Yeah. So we're recording this right now in October. It'll probably come out next month in November. But October is our Sunrise Wealth Advisors RMD month. It's what I was meeting with Travis about when you first walked in today. We make sure that if clients are not on pace to take out their RMDs, they're not doing it systematically every month, or they just do it at the one time. If they haven't taken it out yet, we pull it in October. We send that money out to them. We withhold for taxes, and we get that money out of the accounts because you do not want to forget to take out your RMD.
Don't forget.
Do you know why? Probably
because of taxes.
The largest penalty for making a tax mistake is a 50% penalty.
Good gravy.
So let me give you an example because I like examples. So let's say you have $500,000 in your traditional IRA. Great job saving, investing. We're here for you if you need asset management help.
Okay.
Right? And now you turn 73. So your RMD's going to be about $18,000
a year.
That year.
You have to. Okay.
Just that year.
Okay.
RMDs are year by year.
Got it.
They're going to take that balance. They're going to apply the formula for it, and it'll be 18,000 and change, right? So that 18,000 becomes taxable income. So going back to our first tax issue, now that gets added on to that Social Security, how much of my income is going to be taxed. Second, if you don't take the income, 18,000 was your withdrawal. So let's say you forget. Comes around April, May, the IRS goes, Becky, you didn't take out your RMD.
Yeah.
Guess what? You still have to take out your RMD, and we're now going to charge you a $9,000 penalty.
9,000?
50% of what the withdrawal was supposed to be.
Whoa.
There we go.
So that's why they don't remind you. They make money off of it. Sorry, that's probably really dark.
I was going to say that's really skeptical and cynical of you.
The news cycle's getting to me.
Probably is the case.
Okay.
So a couple issues, obviously, might push you into a higher tax bracket because that's income that.
Now you're going to have double the withdrawal in 1 year, right? So that messes up.
Oh no, if you miss, it's a huge mistake. Yeah, it's a huge issue.
Okay, so the important thing is. Take your required minimum
distributions. Do not wait until the last minute.
Yeah.
This income will increase that combined income number for your Social Security calculation. It may make you less eligible for different tax credits or deductions because now your income's higher. And then one thing we're going to talk about in a moment is it could potentially trigger higher Medicare premiums for your health insurance.
Oh my gosh.
Through something called IRMA, which we will get into in a moment.
Riveting information.
So what can we do?
Tell me the solution.
Okay. You need to start planning before you hit 73.
Got it.
So you can start doing Roth conversions or once you're over 60, let's say you retire early or you're in your 60s, you could start taking accelerated amounts out. Believe it or not, with all the chaos in the world right now, income tax rates are at their historical low as a relative to income and expenses.
Okay.
So it may benefit you if you think tax rates will be higher in the future.
Yeah, but you take it out now. Where do you put it that won't be taxed later?
You reinvest it. You either convert it to a Roth, which then would allow it to grow tax-free and be available tax-free upon withdrawal.
Oh, the Roths are. Okay.
Yeah. Or you pay the tax, you put in what we call a non-qualified or a non-retirement account.
Yeah.
And you invest it that way. Now, when you sell those investments, at some point reallocating, you'll have capital gains, but you get to control that. Well, you and your advisor.
Oh, I'm not like required to take that amount out. So
let's say you took 100,000 out of your IRA and you bought Pepsi stock.
Yeah.
You can hold that Pepsi stock forever and never pay the capital gains on it.
And they're not like, you're 73, take it now.
No. These are only for taxable retirement accounts. So IRAs, 401ks, 403bs, and such.
All right.
So the earlier you start planning for your income stage of life, the more options you're going to have. I think a lot of people that we work with that are still accumulating, especially let's take people in their 40s even. So we're in prime wealth accumulation years.
Yeah.
We're saving money, we're keeping it invested. And if you're aware or not, we're doing things now.
Let's just say I am aware.
let's just say we're going to talk about this later. So we're doing things now with the way we save our income so that when we retire, we have options. And it's much easier to do now or in our 50s or in our 60s even than it is once you stop
Because once you hit 73, then they're like,
toast.
they keep tabs on you, man.
Yeah. Yeah, Big Brother's watching.
All right. No kidding. All right. Tell me number 3 and how awesome it is.
This one, you're going to hate this one.
Excellent. Tell me more.
All right. Capital gains.
I know what capital gains are.
Yeah. We pay. We pay capital gains. You pay gains. You pay taxes on the amount of money you made in a given year versus the amount of money you lost, your losses, for anything that is realized, which means you sold it basically.
Okay.
Sold an investment property, sold a stock, sold a mutual fund. And these are non-retirement accounts. So the RMDs and all that stuff is IRAs. This is your non-IRA part of the ledger, we'll call it.
Excellent.
So far, so good?
Yep.
Okay. You're probably going to be bothered that I'm going to call this the tax torpedo.
Tax torpedo? We got tax triangles, tax torpedoes.
Yeah. There's no tax pillows. There's no
tax cupcakes.
This is a tax torpedo being shot from a tax submarine through the tax ocean at a tax target.
Very aggressive.
And it's going to tax explode something. So
what is the tax torpedo, Nick?
All right.
Tell me more.
So think about what we've talked about already. Income that affects Social Security taxation, RMDs required to take out, so you pay taxes on them. Now you have capital gains. So now you're fortunate. You've made money. Your advisor's doing a great job.
You're downsizing a house. Maybe you sell your house and move to your beach condo. So make some money.
As a little caveat, as long as that's not your primary residence or you're talking about money that's over the threshold for the free capital gains tax benefit you get from a primary residence.
Okay,
do you remember that one?
Sure. No.
So if you sell your primary residence, no, I got you. We sell our primary residence as a married couple. The first $500,000 are tax free of profit.
Okay, but say we make like
$1 million,
520.
Then we owe capital gains on that 20,000.
Okay.
So let's talk about what happens with that 20,000.
Tell me.
The 20,000 first gets added to your adjusted gross income.
Sounds right.
So it could potentially push you in a different higher tax bracket.
Figures.
It's 20,000 that will add to that Social Security number to make sure that you're paying the maximum amount on your Social Security.
Perfect.
So think of it in a year where somehow you have no income, but you sell an investment or a property.
Yeah.
And you have 50,000 of gains. Now your Social Security with no income is still being taxed at 85% because you're over that 44,000 threshold.
Love that for us.
It doesn't take much.
Okay.
And then I mentioned IRMA briefly, but that higher income may actually push your Medicare premiums higher. So it's a real domino effect of I sold an investment because I made money, which is why I think
that's why you have investments, to make money.
Correct. But you have to be really careful when you realize those gains. And there are plenty of examples where we'll go to sell an investment for a client and we'll sell half of it in December, half of it in January. so that we straddle the tax years and we spread out that liability.
Strategery.
Yes, strategic. So this is a little tougher because if you're going to sell an investment either for income or as just part of a reallocation,
okay,
you're challenged by trying to time those sales appropriately. I mean, you could look at donating appreciated assets. So let's say you have money that you're also giving.
Mm-hmm.
Maybe you give money to the church or a non-for-profit. You can donate stock directly. So let's say you have, what I say before, Pepsi stock. You have Pepsi stock you've had since you were a baby, and now it's up 1,000%.
Nice.
You can donate that directly to a charity.
Oh.
They don't pay capital gains taxes. And then you get to donate it without having to pay it yourself. You donate the asset instead of selling it.
And you also get the credit for
potentially
a donation.
Potentially.
I hear that's a thing.
Yeah.
Okay. We don't need to go into that now because I don't know how that works.
We can do a whole charitable episode. But yeah, so this is where I think advisors actually create some of the problem.
Oh.
Believe it or not. Yeah. Because a lot of people I work with, are coming from a relationship with another advisor when they come and meet us. And I'll hear things like, yeah, I didn't really make a lot of money last year, but I had a $50,000 tax bill. And I'm like, whoa. How?
Yeah. Yeah.
And I look at their accounts and the advisor was buying and selling all this stuff throughout the year. Didn't really make the client much net money.
After taxes.
But what they did was they captured all those gains and made people pay the taxes throughout the year, where maybe it would have been beneficial to just hold
seems
that
good
investment.
On paper.
Yeah.
A little, or wherever. I understand it. Like you have investments to make money.
Yeah.
So you need to time them. Okay. All right. So that's what you have to time those. That's how you avoid that.
Yeah.
Capital gains.
Capital gains starts that domino effect. You already have income from RMDs. You already have this Social Security kind of amount that I would just tell everybody, assume your Social Security is going to get taxed at 85%.
Yeah.
For most Americans, it will be. Understand that pensions, 90% of the case, are taxable. There are some tax-free pensions.
Mm-hmm.
Most are taxable. All your money out of your IRA, taxable.
Zoom taxes. Okay, so you mentioned earlier, and we talked about it, but I don't know what it is yet. We have IRMA. And Medicare. What the heck is that?
IRMA's like a bad ex-girlfriend. Let me tell you.
Oh, she's always coming back.
She's lingering. She's looking you up on social media.
Excellent.
She's commenting on pictures that she shouldn't be. It's just annoying.
Okay.
Yeah. Trying to make it a real life example.
All right. So what is IRMA and how does it affect Medicare?
So let's talk about what IRMA stands for. IRMA stands for Income Related Monthly Adjustment Amount. Income Related Monthly Adjustment Amount.
Sure.
Income Related Monthly Adjustment Amount.
Yeah, okay. Got it.
So that's a very fancy way of saying a surcharge on your Medicare bill, your Medicare premium. So this is, how we're dealing with a lot of heightened inflation right now, and people are calling it inflation's like the hidden tax.
Yeah.
This is literally a hidden tax, and this has been here the whole time.
The tax and camouflage. Okay.
Yeah. So they don't call it a tax.
What do they call it?
They call it an income-related monthly adjustment amount. Thanks for lobbing that one up. Okay, so IRMA. IRMA comes into play with your premiums for Medicare Part B, as in boy, and D, as in, drugs. D is your prescription plan.
Oh.
So D is for drugs.
Okay.
Easy way to remember that. So how it's calculated is they will look at the income you made and based on ranges, decide how much your premiums are going to be. The more money you make,
they get to charge you more.
All
right.
But you go,
scaled.
Okay.
Nice.
So here we are in 2025.
Yeah.
Are they going to take my income from this year? The year's not over yet.
That makes sense.
No, they're going to take income from last year, right?
Yeah.
No, they're going to take income from 2 years ago.
Okay. So taxes are last year. Medicare's 2 years.
2 years ago.
Yeah.
Why?
Let's be consistent.
Who the heck knows, right?
Keep you on your toes.
They're doing it from 2 years ago.
Sure.
So, and this is not a sliding scale. This is if you are $1 over the limit, you get the bump up.
Excellent.
So, let's say you're trying to be really proactive about all the things we just talked about. And so in a year you decide to do a big like Roth conversion, a traditional IRA to Roth.
Yeah.
Knowing you're going to have to show that as income.
Yeah.
It's fine.
You've planned it.
We're planning it for the future.
Mm-hmm.
Great. So let's say between your pension, your Social Security, the Roth conversion, all that stuff, you're going to have $206,000 of total income.
Nice.
Jointly.
Okay.
Right? You're fine. If you have $206,001,
yeah,
your Medicare premiums go up $70 a month, every month per person. So that's $1,700 per couple per year.
They're like really sad prices, right? Rules.
Yeah, it's closest to, and it's definitely over. It's not great. So that number gets really big, really fast, by the way.
It does?
Yeah, because your lowest Medicare premiums, and I should have wrote that number down, I think it's about $178 a month per person. The most on that scale is like $600 a month per person.
Stop it. For the same benefits?
For the same benefits. Same exact plan.
What?
Because you're showing more income. So congratulations on your really nice pension, your big Social Security benefit.
We'd
all
like
that money
more
in
of
your
it.
IRA.
Yeah.
They're going to charge you more. Now, it goes in that 2-year historical range.
Yeah.
So let's play this out in real life. Let's say you retire today at 65 and you go to draw your Medicare. Say, great. They're looking at your income from 2 years ago.
When I worked full time.
When you worked full time, bingo. And probably in your highest income earning years.
What?
So you could potentially have a giant bill.
Yeah.
By the way, you're not going to report that. When you go to pull Medicare, they're going to ask you, how much you expect to make this year? And you're going to go, well, I'm retired now. I'm going to make $100,000 all in.
Yeah.
Instead of the $250 I was making at work.
Yeah.
Great. They're going to charge you a premium based on that, probably $175. You get to the end of the year, you do your taxes. They're going to go, hey, wait now. Hold on. You actually showed income 2 years ago at $250.
You didn't ask about that.
You should have been paying $400 a month for your premiums. So there is an exception you can make. So people, the year you retire and the year following, you can go there. You can go online, and when you draw your Medicare, you can submit a appeal letter. It's the form number is SSA 44, Social Security Administration 44. You denote that you've had a life-changing event.
Retirement.
Which is retirement, divorce, death of a spouse. There's options.
Yeah.
So that they don't use your income from 2 years ago. They use your income that year. So they don't use that as the estimate for premiums.
So how many times can you use that form?
You only need it the first 2 years.
I guess only as often as you have a life-changing event.
Yeah. But realistically, you need it the year you retire. You'll need it likely the year after. So you can say, hey, this is my
But if you don't know to file that form.
No, yeah, you're
up a creek. Yeah. Wow.
Yeah, I did a little educational breakout over at the community center like a year ago about this. And you could just see it in the room. I put up the table of the premium differences, and it just totally threw off the whole
really
discussion, because
deflates.
everybody's like, wait, I'm paying Medicare. I just retired this year. I'm paying this, but I already did my Roth conversion. And I go, be prepared. You're going to have an extra $6,000 bill at the end of the year. Married, maybe $12,000 bill that you weren't expecting.
So sneaky.
Yeah. You want to play that?
If only there were a person to help us manage all that.
Well, so by the way, at the end of the year, when you owe another $12,000, where are you getting the money from? Probably your IRA, which you're paying taxes on to take out.
Oh my gosh. This feels...
I know.
Everyone's like, retirement's going to be great. And retirement just seems complicated today.
So I'll be honest. I would have to imagine that 30 years ago, even 20 years ago, if you retired, it would have been easier, right? You'd have a pension, you'd have Social Security.
Yeah.
Maybe you have some investments, maybe you have some property.
You go on your merry way.
Now they've really complicated the tax code so much.
Yeah.
And these numbers, by the way, I'm not even giving exact numbers, because every year the numbers scale.
Feels like a road with nothing but obstacles.
Yeah.
But,
now,
I mean, I'm sure it's
something
it's obviously doable.
Your accountant and your financial advisor should be considering every year for retirees. It's something we consider every year. We're here at the end of the year. We also, the last quarter of every year, look at capital gains. Try to figure out how much gains can we take this year so we don't create any issues. If we can't take any, do we take some losses if possible? I mean, the markets have been really good, so there are not very many losses out there. But There are things you can do proactively throughout the year. Unfortunately, if you wait till, let's say, January comes around, you're done.
It's over. Your window's closed.
You didn't get it done for last year, so it's over. So it's something you have to be proactive about.
Well,
or do what you love to do and either marry
a financial advisor. I don't know.
Or at least defer it. Pay someone to worry about it so you don't have to worry about it.
Okay.
There's nothing wrong with that, right? It's like getting your car fixed in the mechanic. I don't know anything about cars.
Yeah.
I'm going to pay a mechanic to fix my car.
I mean, that makes sense.
Right? So
this has not been a super uplifting conversation.
No, I realized that as we started talking, this is kind of a downer.
Yeah. Sorry, everybody. But I guess it's stuff we need to know.
It is stuff you need to know. So let's put a bow on this.
Yep.
It's important to know the income thresholds. So nowadays you can just Google that. You can Google the IRMA Medicare income tables, and they'll give you the breakdown so you can see exactly what your premiums are going to be based on your taxable income. You also
from 2 years ago,
unless you file that form, SSA 44.
Yeah.
You need to know the income tax brackets.
Mm-hmm.
So just in general, where your income falls on that.
Wow.
Not only for you trying to stay under a certain limit, but let me give you a positive spin.
Oh, thank goodness.
Okay.
What's the positive spin?
Positive spin is, let's say you have lower taxable income.
Mm-hmm.
You could intentionally take more money that's taxable, say, out of your IRA.
Yeah. Why would I do that?
Well, hold on.
Okay.
Bear with me. I'm getting there, babe.
All right.
So if you take money out of your IRA sooner, your RMDs are going to be less, because assuming the account balance will be less over time. So you are kind of like getting through that, churning through that faster.
Oh.
So before they get really big, large percentages, because you remember you asked me on that $500,000 account, it's $18,000 per year.
Because it's a percentage
of
what is in the account.
One. Yeah. So now let's say you take the $18,000 out and your account grows to $600,000. Also, you're older. It's a larger percentage now. So now $600,000 at, say, 5%. Now you need $30,000.
What, the percentage changes every year? Goodness.
The first year, yeah.
What? It's not like it's 15% of the account balance. No, it changes.
It starts at 3.65 and goes up every year. So by the time I think it's 80, you're at like 5.5%, something around there, and of that account balance. So in theory, if you're making more than 5% in your accounts have been growing all those years too. So it's a higher percentage on a higher account balance. Your RMDs are going to get bigger and bigger and bigger.
All right. I don't want, we're getting in the weeds here, but yeah. Okay.
So you could take money out of your IRAs at a faster rate than maybe you would have. I would do that in the case of, let's say you're solidly in the 12% federal tax bracket, and maybe you have an extra 50,000 or so until you get to the 22% tax bracket. So you could take that extra money out at 12%, minus deductions and all these other things we were considering, feeling like I can take it out now and pay 12% instead of later when my income is going to be higher because of these RMDs and other things, or tax rates are going to be higher.
Okay.
And I'll pay more. So there are strategies to pay less. Don't worry.
Okay.
But you should plan your withdrawals. Not only just, hey, I want to retire, I want $100,000, give me $100,000 out of my account. Be aware that if you retire and you go, oh, let me take money out of my IRA and pay off my mortgage.
Yeah.
Like day one, that's all taxable income.
Perfect.
So throw that on top of your income from that year and all these other things. Yeah, you might pay off your mortgage, but you're going to have all these other expenses and taxes and tax torpedoes and hidden things. And then tools like Roth conversions and charitable giving, whether it's qualified charitable donations, which are called QCDs, or any other type of like stock donations we're talking about, are ways, if you're already doing that kind of giving, easy way to get money out to the places you want to give.
Reduce your taxable.
Without having to pay the taxes on it.
Okay. I love you, but I'm starting to glaze over. This is a lot of information.
Yeah.
So
how do you think the average person listening to this feels? Probably just like you, right?
They glazed over.
Yeah. It's pretty brutal. These are things that you would never think about in retirement, but have a big negative effect on the net money people receive. It's incredible.
Okay.
So
on that note,
yeah. So hidden taxes, they're frustrating. They exist. Some are avoidable, some aren't.
Speak to a professional.
Yeah, there is a kind of a sweet spot for a lot of people when we're talking about things like Roth conversions and all of that. So talk to your advisor, talk to your accountant, try to be as proactive as possible.
Okay.
Just so that, again, you're not waiting until you file your taxes in March, you see your big tax liability.
To learn that you have to pay a bill.
Yeah, and you go, oh, crud, this is a big bill here. It's too late. Get it through the year for next year.
Perfect.
I am nervous to ask you if you have a fun fact.
I have no fun facts.
Yeah, this is not fun.
The fact is, this is not fun. Okay.
What part of this wasn't fun, Becky? You learning how much taxes we'll pay over time?
Yeah.
So RMDs, Social Security taxation, capital gains, the tax torpedo, and IRMA. Those are the big ones.
Anyway, okay.
Becky's going to go home and take a nap. This was way too much for one day. All right. Hey, next time.
Yeah.
Why don't we find a light topic?
Yeah, sure.
Something like home renovations or like something fun, like colors that are in for fall. I don't know.
Oh, boy. Okay.
Yeah.
Where can people find you when they need help for the hidden taxes, Nick?
All right. If you're nervous about hidden taxes, sunrisewealthadvisors.com. Go right to the website. There's a box on almost every page. You have questions, just submit it. It goes to me and my staff. We'll get you information out for it. If you are watching on YouTube and you currently look like how Becky's looking, beautiful but completely drained and unamused, reach out. There is information available. We can share that. Otherwise, we're on social media. We're here, obviously, on YouTube, Apple Music, and Spotify. And I know my job isn't always exciting and fun. Sometimes it's taxes. Okay.
All right.
So
on that note, we'll catch you next time.
Yeah. And I'll let you pick the topic next time. How about that?
Perfect.
Chime in next time to see how exciting Becky's topic will be.
All right. Thanks for listening.
All right. Bye, everybody.
Thanks, Nick and Becky, and we're looking forward to your next podcast. And thank you for listening to today's Can I Retire Now podcast. Until the next time, for Nick and Becky, I'm RJ Malik.
Thank you for listening to the Can I Retire Now podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.sunrisewealthadvisors.com or give us a call at 407-351-3476. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Can I Retire Now? The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The views depicted in this material are for informational purposes only and not necessarily those of Cetera Advisors. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors nor any of its representatives may give legal or tax advice. Securities and advisory services offered through Cetera Advisors, LLC, member FINRA, SIPC, a broker-dealer and registered investment advisor. Cetera is under separate ownership from any other named entity. 6052 Turkey Lake Road, Suite 101, Orlando, Florida, 32819.